Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to CEO Jerry Randall of Venture Life, a leading consumer healthcare products firm. So welcome, Jerry.
Thanks, Paul. Nice to see you again.
Yeah, well, big congrats on today's
Thank you.
inline 2023 results, with sales increasing 5.4% like for like to £51.4 million, and reiterating sort of a positive outlook for 2024. So maybe we can start with that sort of top line growth. What's been behind that, good, solid, single digit increase in the top line?
Yeah, sure, Paul. I mean, the like-for-like growth really has come from two places, which has been our distribution gains in the UK. We've had a lot of good successes getting into more stores, into different locations, and also the NPD that we've built. So the new product development that we've done, getting those new products listed. A lot of that happened at the back end of 23 as well. So there's good growth coming through on an annualized basis in 2024. Online's been good to us. Amazon still continues to go very strongly. Internationally, in Ireland, Lift's done very well, and our gel clear products done very well internationally as well in 2023. So across a number of brands and across UK and international.
And I saw most of the split is actually, well, most of the uplift is coming from your own Venture Life brands. It was about 9% plus, I think, for like, and it was sort of like just less. I think it was about 1% was in customer brands. Can you take us through that, because that must also help your sort of like your bottom line in terms of sort of mix and stuff?
Yeah, sure. So the Venture Life brands obviously, give us a better gross margin on the products. And going back to those earlier comments, we've seen growth in Balance Active. We've done quite a lot of new product development in Balance Active. We launched a thrush cream during 2023. That's selling really well, and it's continuing to launch in new locations during 2024. Lift continues to go well. We've got the good new Energy Boost range, which is now starting to roll out in stores. Very happy with that. Earol, the new baby Earol, launched back end of last year. That gives us multiple sightseeing in the stores where it goes. So, across those brands, very happy with how that's rolling out. And as I say, that online presence still continuing to go really well. And of course, what you see, if you look at the numbers, we had a 17% growth in revenues, actual, so not like for like, but actual reported. We've seen a 14% growth in our gross margin in pound note terms, with costs only up sort of 0.4%. So that's where you're seeing that EBITDA number, push up nicely and push through percentage points.
Yeah, I mean, I was looking at the actual margins, and I think you did, according to numbers, 22.5% on your EBITDA margin adjusted, compared to 20.5, so up 2%
Yes.
in this year. How much was that sort of like, pricing, or was it really just volume going through?
It's volume. If you look at that overall 5% increase on a like-for-like basis, only 1% of that was pricing. The rest was volume. So that was, really encouraging. Obviously, on a reported basis, we had the full year impact of Earol, which we only acquired at the back end of last year. But yeah, it's keeping those costs under control, and it's growing those revenues, and that's the operational leverage, continuing to work for us. And over the coming years, you'll continue to see that EBITDA margin progress in percentage terms.
Yeah, and I don't know what the actual final report is today from Cavendish, but from the previous one, they were sort of projecting sort of like 8% like-for-like growth for this year, and a margin of roughly around about 24%, except EBITDA margin. Is that sort of directionally how the business is currently tracking in Q1?
So this year, particularly in the UK, comfortably ahead of last year, doing really well. The international business is more lumpy, so it depends on timing of orders. So, but it's where we expect it to be by this time of the year. And what we have sort of flagged up, of course, is we're going to be investing more in new product development and marketing, and to build the brands. That's really important because the environment's very competitive at the moment, so we have to invest a bit more. But what you'll see also from Cavendish is you'll see that they're rolling our forecasts out now to 2026. So we're going to be investing quite a lot in 24, and that will slightly depress the profitability in 2024, but you'll get the return on that in 2025 and 26 with that additional investment. So we're going to be increasing our investment in the UK brands, the percentage of revenues, almost doubling it in 2024 compared with 2023. And the Cavendish update will reflect that, but you'll see the growth that comes through from that and the return on that investment in 25 and 26.
Great, yeah. Look forward to seeing some of those new products hit the shelves. Do you just take us through also the strategic rationale of sort of like expanding that private label? Because obviously you have your own brands, that's Venture Life. You have customer brands, that's actual brand owners, third parties, and now you're introducing a third section, which is retailer owned brands, so the likes of Boots, I guess you're going to be mad. You just take us through the logic of having those sort of three streams.
Yeah, so we already do some of that business in effect. We've reported it within our venture life brands because it's our products at the end of the day. So a couple of million in 2023. But the interesting part about private label, if you look at the European landscape, a third of, particularly in the UK, a third of consumer health products are private label. So UK and Europe. So if you look at that, each time you go into somewhere like Boots or the other stores, a third of those consumer health, the consumer products, are private label. So it's a really big area. If you look at the States, I think it's only 14%. Far East is 5 or 6%. So it's a place where we have to be. And you look at a lot of the big players in this space, like Perigo and others, who are bigger versions of us. They do this. And what's important is you get a number of benefits from it. So obviously you increase production volume and gross leverage, you maximize your internally developed products, you build stronger relationships with the partners. But interestingly, you're still making the same EBITDA type margins as you are with the brands, because with our venture life brands in the UK, you get a higher price because they're going to the retailers, but you have to invest in that sales and marketing support. You have to do promotions and whatever. With the private label, you don't. So you're selling it to the retailer at a lower price, which is better for them. They're able to offer it to the consumer at a lower price. But because we're not spending on sales and marketing, we're still making the same EBITDA margin. It's really important, though, that you differentiate the products. So we're not just giving them venture life brand products. So they may be in the same therapy areas, but they're differentiated. They won't be the same. So you won't be able to say, well, that's the venture life product and always a private label product. That's exactly the same. So you make sure you differentiate those. We already do sell products under Boots number 7 brand. It's private label. We sell Boots under, we sell products under the Superdrug private label and in Croydon. So it's something we know very well. And also within our development facility in Italy, we've got over 1,200 formulations of products we've developed over the years, which is a fantastic base to be able to move and offer private label. So we're seeing really strong interest. We're working with a number of these retailers I've mentioned already in developing new private label products for them in skincare, in women's health, in areas that we're in. But we're also seeing it coming from the wholesale channel and new retailers that we're talking to, not only in the UK, but across Europe. So we see it as a really strong growth here. And going back to that original sort of picture, a third of consumer healthcare products in Europe are private labels. So it has to be a place that we play.
Yeah. How would you just give an example of how you differentiate it? So let's just say you have a cream or something like that. There's your own brand or a third party brand, which is important. And how would you differentiate? Would it be through packaging, or would it through recipe, or how would you do it? Size? I don't know.
It can be any of those. So, for example, we could in certain territories, for example, come up with another skincare product similar to one we make, but you might package it in a different format. You might give a spray instead of a cream. You might give a smaller product. You might make it a multi-pack rather than a single pack, but you don't get direct read across. That's the really important thing. And it's something that the retailer themselves know that's their only products. It might be a particular, flavor in a mouthwash category, for example. It might be a particular, fragrance or a particular size or a particular way of delivery, but something that differentiates it. So it's their own product and people can't go and buy it from others, and it differentiated from the venture life brand.
Yeah. And I guess that extra volume then is going to help you fill or increase the utilization of your existing manufacturing facilities. I think you got one is it Sweden, or is it something like, I can't remember exactly where
it's Sweden, yes.
Yeah.
Yes, it is. Yeah, it's just south of Stockholm. So yeah, both Italy and Sweden. And again, you've seen, as I said earlier, sales up, margin up, costs not moved, extra profit to the bottom line. So the more volume we put through is generating more revenue, generating more pound note gross margin, and that's going through the same overhead base. So yeah, any more volume you put through those facilities where we have plenty of capacity will drop through essentially to bottom line profitability.
And then if in the fullness of time, then how big would you expect this sort of the private label to be? Because you've got, the split of currently is roughly around about sort of 40%, which is third party customer brand. You've got 60% your own, of which was it 2.4 million is the is the private label. So private label is what, roughly around about 5%, is it something around that sort of level? Yeah. So you've got 55%, 40% and 5%. Where would you sort of broadly what think that might get to in 3 years' time?
Yeah, I mean, bearing in mind that all those areas are growing, so it's not a case of one will be growing and the other's not. But I'd expect that we'd still continue to drive up for our venture life brands to be driving up towards the sort of 60-70% without any problem. And I can see private label doubling in size every year for the next 2 or 3 years as you begin to roll that out. So you could be looking at 10%, 15% of our business in 2 to 3 years time. And certainly with everything we have ongoing and the discussions that we're having, I'd deem that to be very realistic.
Good. How, just in terms now of the sort of supply chain with input cost pressures, obviously, luckily, the cost of living crisis is reducing, and CPI, thank God, has started to fall. How are you seeing that at the coalface in your sort of input costs?
Yeah, I mean, we're definitely seeing a tailing off of that inflationary pressure that we see on the input costs. I mean, I wouldn't say we're seeing deflation. I think that's optimistic on everybody's count, but we're definitely seeing a tailing off for the inflation. So again, we had to put some more price increases through into this year, so there'll be an element of price going into this year's numbers. But we're certainly seeing going forward, we're not having those same pressures of increases during 24 on the cost side that we've seen before, and I think we're finding the supply chain becoming a bit easier. I mean, I noted recently, Panama Canal water levels are low and things like that, and people are worried about that, but we haven't seen any impact on that as at present. So absent, I think we say this every year at the moment, absent those black swans that come along and bite us all in the backside, we don't see particular issues on the supply chain through 24.
Yeah, I did actually see on your balance sheet, I think your stock days have come down, haven't they, year on year, because you've obviously got much bigger sort of turnover on a sort of slightly increasing inventory. So your stock days must have improved.
Yeah, they have, and I think that's 2 reasons. I think going back to if we look at coming out of COVID into 21, particularly into 22, you remember we were getting people to order a lot further forward because we need to order further forward in order to have the supply. So our forward order book went up, and but consequently our inventory went up as well. And so we've got much better real-time ordering now. So we're ordering inventory tend to be on a sort of 6 to 10 week basis rather than having to be a 6 to 10 month basis as it was a couple of years ago. So it's been that, and also I think we've just been much more rigorous in cash flow, because investors, shareholders want us to get that leverage down as fast as we can. So again, squeezing our inventory, making sure we're being efficient with that brings more cash into the balance sheet.
Yeah, your CFO certainly seems to have done a good job improving the margins and generating a lot of cash.
No, Danny's done a fantastic job.
I did see. I mean, you've got your free cash flow was £4.8 million last year, and now obviously you're entering in 2024. And I did see the Cavendish note saying you're going to generate roughly, or reduce the debt round about sort of 5 to 6 million again this year.
Yes.
Is that a similar sort of level? So if you're doing, I think it's 13.7 million of net debt. So you may be round about sort of like 8 or 9 next year, something like that. Is that?
Yeah, I'd expect so. Yeah. The cash flow will continue to drive that down. So we're very happy with the cash generation business. We had a super year in 2023, but we've got other things going on in 2024 that will improve that. So we're starting to internalize the EROL production. That'll start from mid-year, and again, that's going to give us improvements of marginality, but also reduction in working capital because we're making it from raw materials rather than buying finished goods. So there's other things that will start to contribute into that cash flow as well.
Yeah. Okay. Good. Well, I mean, if that's sort of directionally correct, then obviously I'll look forward to seeing the final Cavendish note and stuff. But that would drive a leverage ratio well below 1 by the end of next year, etc. I guess the question then comes back: will the board ever consider paying dividends, or is it you've got such opportunity and to invest inside the business?
Yes, there is. I mean, it's. I'm sure, as you'll be aware, when you talk to people and you talk to institutions, you talk to retail, there's 1,000 different views on leverage, interest rates, and everything. So you've got on the one hand, people wanting to deliver, the others wanting a dividend. So yeah, absolutely, we are considering when we bring a dividend policy, and obviously it's not come in for this year, but it won't be in the too distant future, but it won't be big. But delivering is important. I mean, another thing just to bring up, of course, people will be wary that our RCF is due for renewal in 2024, but we've renewed that, and in the RNS we set the details out, so we've renewed that at better terms going forward. So that's all plenty of availability, and I'll be championing it a bit to use that to do M&A, because there's some fantastic opportunities at the moment, but obviously we've got to balance shareholders concerns to make sure that we're not over levered.
Brilliant. Well, that's great. Positive thing in terms of in that RCF. How what's the sort of timescale? Is it a 3-year facility or 5-year
Yep.
facility?
Yep, 3 years. We first took it out in the summer of 21, so it's just renewed to 24. We've taken out the same size facility, so we've not increased or decreased it, but we have negotiated some better terms in that, which is obviously favourable for us. And I'm hopeful very soon I'll be able to use it again.
Brilliant. Okay. Well, big congrats again on the positive outlook and the strong results for last year. Your teams did a great job reducing your leverage and improving margins. So you've hit all the right buttons there. And just in terms of your AGM, is that going to be usually around about May time, mid to late May?
I think it's early June, yes.
Early June. Okay.
It'll be there, and obviously we'll give a bit of an update at that point. We're very pleased with 23. The team's done a brilliant job. Across the group, fantastic people, really delivered well for us, and doing well in 24 as well.
Great. Well, thanks for your time again, Jerry, and look forward in touching base for the AGM in June.
Great. Thanks very much, Paul. See you soon. Thanks. Bye bye.